evening, everyone. My name is Charming. I'm a full-time trader for the past 7 years, and I trade in forex, stock markets, cryptocurrency, and also do automated trading strategies, which is like using grid trading strategies. So today I will share about the introductions to basic put option strategy, and I have been sharing about trading psychologies, grid trading strategies, and also option strategy in past few weeks. So make sure you all follow me to start in this trading journey. So first of all, I will just start with the basic one. Wait a while, a little bit busy outside. Okay, sorry, because okay, alright. So today I will share about how to deploy put option strategy and how do we execute a put options. So today I will be introducing you all about put option strategies. Last week I talked about call option strategy. So today I will talk about how to deploy a put option strategy. So let us recap what is option again. Option allow you to profit in any market conditions with any assets, such as ETF, stocks. So from here you can see, actually we can use options to profit in uptrend, downtrend, and also a sideways market. There's a few strategies in using option trading. However, we will start with only the basic one first, then we slowly get into the more advanced one later on. So in trading, we need to know what trend and what current market conditions we are into now. So we can by using the analysis, we can by then deploy a good option strategy to maximize our returns. So when the market is very bullish, we can actually execute the call option strategy, and when the market is very bearish, we can execute put option strategies. However, when the market is sideways or very slow, we can actually go in to sell the options. That's selling option strategies, and many kinds of strategies that can cover different types of market movement. Some of the strategies we also use to tackle earning, and it's quite risky, but the return is very low. So it really depends on what type of market you want to trade in option trading. However, we still need to learn the basic one, and then we slowly develop our own option strategies, and as the experience goes, as the time goes, our experience will get more, and we can become profitable traders in any kind of market conditions. So there's plenty of option strategies in the market. Today, since I'm doing a basic option trading strategies for for beginners, so I hope you all learn something here today. And this is my sharing sessions, and thanks for you all for coming. So let us recall what is options. It is about the rights versus the obligations. So buyers have the right. So in options, the buyers always have the right, for call buyers have the right to buy, and the put buyers have the right to sell. If you all still remember, call buyers always have the right to buy or not when the expiry date hits, the option expiry date hits, while the put buyers always have the right to sell or not to sell. So for those who don't understand the basics of the options, you all can maybe look back to my previous weekly trading class, or maybe you all can add me in maybe at the last of the sharing sessions, and hopefully if there is enough amount of people, next time requested, I can do a class again. I organize a class again. Alright, so here the basic one, the buyers always have the right for the call buyers to buy or not, and for the put buyers to sell or not. So in options, buyers always have the limited risk. So it's just like when you open a call options strategy, you do a long call strategies, you always lose the maximum premium price on it. So you only have a limited risk. Let's say you just put $100 in buying the premium of the long option. So at most you will only lose $100. However, the return is like unlimited. So it's the same for the put buyers. When you open a long put, you actually just lose the maximum premium. So it's just your maximum risk is how much you put the money into buying the premium. Alright, it's very easy to understand. So let's talk about the sellers. Sellers always have the obligations, unlike the buyers. Buyers always have the right to choose. Call buyers always have the right to buy or not, and put buyers always have the right to sell or not. However, for the sellers, they have the obligations to sell or not, and also to buy or not. So for the call sellers, they are obliged to sell, and the put sellers, they are obliged to buy. The call buyers will buy the call from the call seller, and the put buyers will buy the put from the put seller. So this is the relationship between these two, and basically in option trading, the only relationship is call buyers versus call sellers, and put buyers versus put sellers. Alright, it's not hard to understand. And put sellers always have obliged to buy. When the put buyers have the right to sell, they want to sell, the put sellers have to buy. And when the call buyers have the right to buy, the call sellers have the obligation to sell. So this is their relationship. And always remember, the sellers always face unlimited risk. Because for the exact reasons, you all can look back to the past weekly trading classes, basic trading classes. And here, I think if I talk about it again, it will take a long time. So you all just have to remember, the buyers have the right, the sellers have the obligation. The buyers, for the call or put buyers, always have limited risk, whereas for the sellers, they always have, the call sellers and put sellers, they always have unlimited risk. Alright, so I think this is the basic concept of options, call and put options. So last week I have talked about call options. So today let us dive into put options. So last week I shared the strategy one, which is long call. So we buy long call when the market, we want the stock price to, we want to benefit from the upsurge of the stock price, the uptrend of the stock price. Whereas for long put, we want the stocks to come down in order to make profits. So when to deploy this put option, long put option strategy. First, we must know the market has some sort of bearish signal. So it either depends on the fundamental analysis or technical analysis. I am actually I'm more prone to technical analysis, and the fundamental analysis I am just used as a support to make a decision in the market. So I'm basically 80% time I'm a more technical trader. So it's no right or wrong. As we trade, everyone has different types of views. So some people look good, some people look bad. So it really depends on your goal. Some people see long term, some people see mid term, and some people see very short term to very short term. So you have to know what you're exactly planned. Right? What is your time frame? How much do you want to put your balance, your capital into it? How much you face the risk? How much risk you can lose? And what is the target? All these trade plan you have to think and plan before you enter the market. Alright? I think I talked too far. Let's get back here. When to deploy. So when you see a very bearish reason where whatever in fundamental bearish view or technical bearish view, you can consider to open a long put. And then you expect this move can move very sharply, because even though sometimes we look there's some bearish signal, however it is not strong enough, right? When it's not strong enough, when we open this long put, there is a expiry date, and then we don't want the market is like maybe sideways for a very long time. Then we have the potential of losing this in this long put. So we want there's some kinds of volatility, and there's some kinds of volume interest and open interest in this stock, so that there's a high probability that the stock price will move sharply. So when we open a long option, we want to look for a low implied volatility. So what is low implied volatility? I think last few weeks I talked about is one of the extrinsic value that can cause the market, one of the extrinsic value that cause the volatility of the stock price. So we don't want the volatility is too high, because when the volatility is too high, the premium can be very expensive. Things like that. Take an example for Nvidia. This stock is very hot, right? It's a hot cake. So when people buy this stock, many people chase in, the premium become very expensive. So it's not worth you buy it and you chase at high. It's just like when a stock is being pumped for maybe over 20%, then you only jump in. Definitely you will buy a stock price at a premium, because you didn't buy at a discount when it dropped, right? So this is the same concept. We want a fairly low implied volatility, low IV. So here my criteria is the IV must be less than 40%. So this one actually is very subjective. Somebody just want to trade the very hot stock, and the volatility maybe can go over 50%, but if it is within their tolerance, risk tolerance, I think it's okay to go, because in trading, many things is actually very subjective. So there's no right or wrong. It depends on what is the plan of the people. Okay? Okay, next. So here we talk about the risk reward. So when we open a put, we want it to like drop a lot. There is a target that worth this trade. Why? Because when you open a stock, you risk 200, and then maybe your target is earning only 80 and 100 is not worth, because when you lose one time you lose 100, but or 200, if you put 200 you lose 200, but when you earn just maybe 80, 100. So it's not worth, because when you win one time you cannot cover your one time loss, but when you lose one time you need 3 times to cover the loss, 2 times to break even, and 1 time to like actually profit. So in risk reward, it's actually very important in trading. So this is basic trading strategies or basic trading analysis. I covered trading basic strategy and analysis also, and also knowledge in other classes. So you all can also follow me. I will share about the psychology and how we read the chart, the basic chart, how we read the indicators, how we read the chart pattern, and how we formulate our own trading plan, including risk reward management. Okay, next. So next is a technical reason. We see at the optical technical patterns, like there is high momentum in the stocks, and the price is actually breaking down from consolidations. So in the market, sometimes the price can sideways for a very long time. So according to market structures, when it's sideways, there is 2 things will happen: break up or break down. So it can be accumulation stage to go further later on, or distribution phase to go lower. So you need to have this few criteria, and then you do a checklist before you enter the market. However, this is my basic put option strategies. There's a lot of trading strategies outside there. So I will just pick a basic one and then share with you all. So you all can maybe start from this and then slowly develop into own strategies when you got more understanding about this option trading. So no sweat. So we take it slowly, and then you all just maybe follow my pace first. Then eventually you all still need to like really trade in the market, so you can feel the market's heartbeat and then become a better trader. Alright, and the most famous one in technical analysis reason is the price reject from a strong resistance. Okay. So the most common retail strategy, here I mentioned retail strategy, is because there's 2 types of trading strategies in the market, and the most common and basic one is retail strategies. In retail strategies, actually the risk reward is not that great, but still you still can profit over the long run if you manage the trade correctly. And there's another strategies which is institutional trading strategies, which is a more advanced one, but that one more advanced one I will leave it in futures. Now I will just talk about the basic retail strategies that you can find in the market. Alright, so here I use MA strategies to find a downtrend stock. So what is MA? MA actually is a moving average strategies. You can choose these indicators in the trading charts. You can find in the trading chart indicators. You just type moving average. So here I use exponential moving average, which is slightly more sensitive than moving average. Here you can see there's a thin red line, blue line, green line, and also slightly thick red line. So all this is the lowest one is EMA 20, EMA 50, EMA 100, and the top one is the EMA 200. What it means by MA? MA is the moving average of the average, like let's say 20 is the average of the last 20 stock close price. So when the last 20 days the stock price is getting lower, it means that the market in the past 20 days is getting lower. And if the line cross below the 50, and then 50 cross below the 100, and then the 100 cross below the 200, then we can say that, safely say that this market, this stock price is on downtrend. So for 20 below 50, we can say that it is like maybe short-term downtrend. And then if the 50 below 100, we can say it's a mid-term downtrend. And if the stock price is below 200 MA, we can say that it is on a long-term uptrend. So we try to avoid these long-term uptrend stocks when we long the market. However, here we want to find a long-term downtrend stock so we can short the market, so we can open a put to get profits from the downwards movement of the market, right? So here you can see that the EMA 20, the signal appears when the EMA 20 crosses EMA 50, then EMA 50 is crosses EMA 10, and EMA 10 crosses EMA 200. So you can say that this stock is downtrend in short term, mid term, and also long term. So the chance of you to short this stock is better, is higher. So you get a higher probability when you short this downtrend stock. So we don't want to counter the trend. Trend is your friend. So we want to move according to the market trend. Alright, so here it is not hard to understand. So we just wait the crossing, the lower moving average crossing down the higher moving average. Then when this signal appears, then when it rebound back to near the crossing EMA line, we can consider to open a put option, long put option. Alright, so it's the same stock. So we look back, you can see this stock actually tried to like rebound. However, when it rebound back to the 200, the 200 EMA didn't manage to like go below. Means that the shorter EMA line didn't manage to cross above this EMA 200. So there's no signal of buying this, in buying this stock, in longing this stock. So we still remain that we still can safe to say that this Pfizer stock is still on the downtrend. So this will benefit it more if you trade the long put options. Alright, so here there is still no signals and it consolidates. Remember, when a stock starts to consolidate, it either will goes up or goes down, right? Because it consolidates, actually it's like waiting for something to happen. Then if good thing happens, it will go up, and if bad things happen, it will continue to go down. Alright, so this is how we use MA strategy to trade the market. So when it's still under the EMA 200 is still under, the stock price is still under the EMA line. If you want to invest, we don't invest in this kind of stock, because this is long-term trend. The price will only go lower, lower, and lower. So next, the very famous technical analysis is we see the support and resistance. So as you can see, what is support and resistance? You can see there's a, like when the price fall down, it will have the supports there, and then when the price hit a certain price, it will have the resistance. So the markets will reject from the resistance and also bounce from the support. So we want to try to like trade at this market long or short at this area. We don't want to like short in the middle of nowhere. We have to know that there's a high or low of the market. Then we try to find the support and resistance. So here you can see in every range, I circled it. You can see that the market will somehow react to those areas. Then those areas can become support and also resistance. So when the price rebounds from a support to hit the resistance, and then when it continues to break the resistance, we call breakout. So we can wait that it breaks the resistance, it comes back to the previous resistance, and if it's from another support, then we can continue to long it. Then if the price moves towards the resistance and reject it, and then another time it move up, it also reject it. There is a strong signal it rejects. Then we can consider to open a put options. We can consider to long a put options because we want to trade the short-term downtrend or long-term downtrend. It depends on the market structures, right? So we need to find those strong resistance. Then we open a long put in order for us to earn from the market by the stock price when the stock price crashes or make a correction. So in this examples, I have used NVIDIA as a examples for support and resistance. So we try to not draw the support and resistance in the very small time frame. Like just now, I just used for illustrations. We try to make it simple. We just try to draw the swing high and the swing low. So to make it for us easier to trade, we don't trade like in the middle one, because in the middle one is for the short time frame. So we as a beginners or newcomers in trading, we try to trade the big time frame, and maybe as the time goes, when we have more understand about this market, we can try to go into more advanced one. But from here, I just share the basic one. We just plot the basic support and resistance, and then we will look at is there any points we can make entry in open put options. So from here, you can see on the right side, the Nasdaq actually breaks out from the previous resistance, and then now it's currently testing the previous resistance. So now the resistance will become support or not, we still don't know. We still have to wait until maybe very bullish candles appear or very bearish candles appear. Then we only execute our plans. So this is how we read support and resistance, and we try to open a put at the major resistance. Or if you think the market price is too high, you want to hedge your portfolio. So you can also consider to open a put option, to long a put option, to help you like hedge your portfolio in case there is a potential like big crash in the market, or maybe there's a very news in the market, and you feel market is not doing good or market is not alright. You want to protect your portfolio, so you can consider to open this put option strategy. So I'm not sure how many people have using this NVIDIA. I have using this uSMART option trading before. Here I will show you all how do we buy an option, buy a option, put option. So when we press it, we choose the stocks. Here I choose the NVIDIA stock, and then there is an option word set here. So then we continue to press into these options, and then you will see all these information. Price, first ask, quantity, first bid, changes, all this. Then at the below, you can see there is all options, call or put. So now we want to do a put options strategy. So we just press the put, and then you enter into this kind of surface. Then we need to choose the expiry date. Alright, so here I picked 17th January 2025. Why? Because it has 52 days in more than 1 month. So because in options there is time value, the time values will cause the price to decay, the price to decay, so we want to find at the longer expiry options. So after we choose the expiry date, so we still have to look at what price we need to bid or what price we need to buy for the put option. So you can see the top one, what is first ask and what is first bid, and what is the price. First ask is the price that you need to queue to buy. However, the first ask is the price you can just directly buy it. Like now is $8.55. If you want to open this one contract of options, it costs 8.55 times 100. Why 100? It is because one contract equals to 100 shares. So here for the premium price is 8.55. However, if you want to queue, the Q1 now is 8.4 is the Q1, and the ask one is 8.55. 8.55 you can directly get the price, whereas if you want to wait for 8.44, you have to queue and wait people to sell to you. And for the left side, the price, actually the mark price, is the between of this first ask and the first bid price. So usually in this case I will just pick the mid price, which is 8.5, and then yeah, this is basically the info we need to know. And then the top one, actually you can just scroll, and then there's a lot of other information like the risk value, and then the open interest, the implied volatility, premium rate, leverage, and all sorts kinds of information. But I think maybe we don't need to focus too much about that yet, and we just follow the basic one to how do we open a long put. Alright, so after we choose this, then we press into it, then we press, just now we said 8.55, then we press it, we press into it, then you will see this kind of market, this kind of information. Then you press at the bottom right, trade, and then press the buy. Then buy, that's limit orders, 8.5, one quantity, and then your premium price, one contract will be 850, which shows below, because remember one contract is 100 shares. So then you press the unlock to trade, you key in your PIN number, and then you are good to go. Then you press buy again, then you are good to go. So this is how we use uSMART to open a put option, to long a put option, to buy or sell. Alright. So until now, so how many people, is there any people who got any questions or don't understand about how this thing works, or maybe need me explain something, maybe you all can consider to leave a message. If no questions, then I will continue. So this is risk profile of options. When we all buy a put options, the apps will show how much you will lose, and then you have to count that how much you can profit. So we just do a revision. I explained about this risk profile for the past few weeks, and here we'll talk about this. We'll explain it again. So if you see a long put, one contract of NVIDIA at 136 strike price, put option at $8.5 premium. So this is the risk profile of this contract looks like. First we have to plot this 136 strike price, and then to break even we need to deduct by 8.5 premium, which is 127.5, and then our maximum risk will be the premium we paid. In scenario here is 8.5, but we still need to times 100 shares to become 850, because one contract consists of 100 shares. So for buyers in options, either call or short, the maximum risk you face is you lose only premium price, maximum already. So here is 850, maximum you lose 850. Alright, very easy, then we continue. So how much can we earn when the price continues to drop? Because we long a put option, right? So as the price going down, we are actually generating, we actually become more profits, have more profits. So when the NVIDIA drops to 100, our calculations will be 136 minus this 100, then minus this premium which we paid, and then equals to 37.5 times 100, which is 2750. So this, you can see that the return is unlimited. Actually the return is not unlimited in put options, because when it drops to 0, it will become 136 minus 0 minus 8.5. So there's a limit of this put option. However, for the call options, when you long it, the return is really unlimited. Alright, so this is just for the understanding. So this is how we read this risk profit profile. Alright, this is not hard. Okay, so you all remember, you all have to really maybe really need to ask me any questions if you all maybe you want me to slow down. Because I scared that I go too fast, or there's too many informations, or I'm not sure if you all didn't do any reactions. Okay, if no, then I will continue again. Okay, now, first of all, this is not a buy call or anything. I just make a study for you all. So now next I found this stock, which is called Qualcomm. So you can see that there's the major resistance, the highest there, and the lowest there. There's a lot of support, right? When the price going down, it hits and rebound. When the price go down, this area again, it goes up again, and then now it drops down again, and then maybe it can go up and continue to go down, or maybe it can rebound here to go up. So we need to find this area, this support area to long, and the resistance area to short. Alright. So I will just take a study, then we look it back. At the top, you can see there is a bearish signal. Then you do a sharp rejection, bearish engulfing at the resistance, and then the price went down. So the targets will be the support. Usually the price will move between resistance and also support. So the price is constantly moved between resistance and support in hourly, in minutes, in 15 minutes, in weekly, in daily time frame. It will keep repeat. So to avoid more errors in technical analysis, I recommend that you all start from, for beginners, I recommend that you all start from the high time frame, 4 hours or daily, to read the support and resistance, to plot the support and resistance. Because if you plot at the lower time frame, it will be very confusing. Alright, so let's say we want to short, we look it back, we want to short this Qualcomm from this area around 220 something, and then our target is below this, maybe around 160. So when we find this, so we want to open we have identified that this market, this stock is on downtrend. It has potential downtrend, or maybe there's a potential big correction. So we need to determine that we want to open a long or open a short. If we want to open a long, we need to buy a long option. However, if you want to open a short, we need to open a put options. Alright, very easy. So we identify this as a very sharp. What's next? So currently the price is at 228, and we have decided that we want to buy one contract of QCOM at 27th December 2024. The strike price is 230, just now it's 228, put at $7.1. So this is just a fake scenario. I just put it for you all in order you all know how to read the options information, and how you all calculate it, and how you all make a decision in this plan. So time to do the exercise. So from this long QCOM 27th December 2024 at the 230 strike price put option at premium $7.1, how much does it cost to buy one contract? What is the premium? Anyone have any answers? Can maybe type down on this chat box. How much will be cost to buy one contract? Okay, so it will be 7.1 premium, as I said, for the buyers of the call or puts. The buyers always had a minimum risk, which is they lose the premium price only. So here the premium price is $7.1, and one contract is 100 shares. The answers will be 7.1 times 100. So next, what is your maximum risk? Your maximum risk will be your premium. So just now the answer is 710. So now the maximum risk is 710. And then next, what is your break-even point at expiration? So it's very easy. You just take the strike price minus the premium price, and then the price has to move below this in order for you to start profiting. So it will be 230 minus 7.1, which is 229, which is $223.9. I didn't write it here because I write my answers in behind, so you all can screenshot and maybe do homework by yourself by maybe looking at others stocks. You all find the information yourself, and then you all maybe have an idea on how to read and study the risk or potential you can lose in this option. So if QCOM price goes to 230 before expiration date, what is the minimum profit you would earn? Here should be 160. I think I write down the wrong one. So here's the answer just now. Maximum loss will be 710. Maximum risk is 710 too. The break even will be 230 minus 7.1, 222.9. And then if the QCOM price drops to 160 before expiration date, what is the minimum profit you will earn? So it will be 230 minus 160 minus 7.1 equals to 662.9. 10 times 100, then it will be 6,290. So your minimum profits will be 6,290. And why I said it's minimum? Because this is only we calculate the intrinsic value. However, there's potentials that there's another extrinsic values that cause the price to can search more. So we didn't calculate the extrinsic value, so we just calculate the minimum profit, which is the intrinsic value. Potential intrinsic value of the profit is 6290. So next, draw the risk return graph showing the maximum risk. So it's the same. We start with the strike price, then we minus the premium, and then below this premium price, these prices, which is 222.9, you only start to earn money. So here your maximum risk will be 710, and then when it drops to 160, your returns will be 6290. So it's very easy, right? The put options actually is just the opposite of the call options. However, because since you all both is the same, have to pay the premium. So the difference is one call options benefits when the price goes uptrend, and the put option strategies is benefited from a downtrend of the stock price. Okay. So I hope you all understand on how do we read these basic option strategies. How do we read those platform basic information about option strategy? How we execute this option strategy. So all in all, this is a summary on steps on how to long a put. First, we want to identify a bearish trade on a stock, index, or ETF. Then next, we need to find the IV percentile which is below 40%. Then we need to check the option chain. Like just now I said, check the option chain, the strike price, the open interest, the IV, the first price, ask price, bid price. Then you plan your trade and open a option, choose the options you want to buy, and then you execute it. Then you need to choose the date to expiration. At least 60 days is ideal, because last 30 days the time decays is very fast. So we also choose this strike price with 0.5 to 0.6 at the money, or one strike, or one at the strike in the money strike price. For those who don't understand this, you all can refer back to the extrinsic value classes. And then we choose minimum one quantity of the contract, choose how much we want to buy, and the total premium will be less than 2%. It means that every trade we shouldn't risk more than 2% of our portfolio. So we can, theoretically, we can lose 50 times by using this 2% trading risk management. Then we analyze our risk reward. So we need to plan when to exit. So we have to see how much we want to earn, and when the price hits certain price, do we want to TP or not, or anything you want to do with it. What is your trading plan? You need to know everything. How much you buy, what's the exit plan, what is the entry plan? Because in trading, once you execute everything, you just wait on it. You already done your job, and the judgment day will be the day after you execute the plan. And next, it will be you place a limit orders, bid or ask. It depends on you. Then you ensure the bid ask price is not more than 0.5. I think this really depends on everyone's strategies. I just share with you what criteria I will be looking at when I open a long put. Alright. So next I will be talk about a little bit of risk management on how to exit a long put. So when it didn't reach the expiry date and the stock price actually reached the target price, I usually will just close everything. Why? Because you don't want to risk it when it suddenly drops back, right? So when we hit the target, we just close it. Don't be greedy in the market. Then intended risk reward target risk is the same. When you reach, like maybe you put 200 and you earn 600, your target is 600. When you hit, you just get out. So you don't have always think that you want to. Somebody's like you trade 600, you earn. I realize profit 600, and then you want to wait it sell. It goes up until 1,000. When you hit 1,000, you want to wait it until 2,000. So you cannot control the market. At least you can control what is the basic risk reward. And then avoid the time decay. So we want to buy the longer expiry date options. And then for the risk management, we sell the call option at a loss. Just now I said that I will put the 2% cut loss, right? So sometimes when it goes wrong, when the premium drops below 50%, I will also consider to cut it already. Then by theory, I actually just lost 1% in this trade. And then when the market, the option reaches 30 days before the expiration, I also will consider to cut off, and then maybe cut off at some losses, and then get into another longer expiry date option. And sometimes things will turn right. When today you see the price is very good, very bullish, maybe 2 days later there is a bad news about this stock, and the technical reasons or maybe fundamental reasons change, and you had identified that the market, the stock no longer in bullish trend, then you can consider to get out at losses. So all this risk management, actually you need to really must understand everything. Then you have to practice in order to make your own plan. So trading, theory is by theory. You need to do a live trading in order to get to know what trading is. Some people say that the demo trading is good, but I don't think demo trading is good because it didn't involve the real psychology. In markets, 80% is about psychology. If your psychology is very weak, you can hardly win the market because your greedy emotions, your few regret emotions will be overwhelmed, and then you will make bad decisions. When you make bad decisions in the market, you can eventually lose a lot of money and get into the gambling mindset. So as a trader myself, this is what I can share with you all, and I hope no overtrades for everyone, and I hope you all can take it slowly in trading journey. So I have ended my presentations today. Any questions? So next time I will share with you all how do we select the stock. I'm using this trading view to filter the uptrend and downtrend stocks. Then we try to find a good one to long or short the market. And this is my uSMART referral code. For the left side is for Hong Kong user, for the middle one will be a Singapore user, and the right side will be VCOM, which is you all can use WeChat to add me. So if you all use my referral code, please add me and let me know. I actually got another Telegram group, but now I don't think the group is active because too less people, and I still don't know what to do with the group. I just open it, and if there's a certain amount of people using uSMART to trade, eventually maybe I can do a live trading, not live trading, maybe anything, and maybe offline classes within this group, online classes within the group. It really depends on your support. So let me know if you all add me or using the uSMART app. Okay. So no questions for everyone. So if no questions, I will just end my sharing session today, and I hope you all learned something today. Trading actually is not an easy job, and it's the hardest way to earn easiest money. So I hope you all take it serious as a business, and then hopefully we all can always beat the market. Alright, thanks for support and thanks for listening. Have a nice day, and I hope you see you all in the groups. Peace.